Hi everybody, and welcome back to video number 2 in chapter 17. And when we left off, we were looking at a contracts and recognition example. So here, the facts: on March 1, 2025, Margot Company enters into a contract to transfer a product to Sun Yun on July 31, 2025. The contract is structured such that Sun Yun is required to pay the full contract price of $5,000 on August 31, 2025. The cost of the goods transferred is $3,000. Either party can unilaterally terminate the contract without compensation. Margot delivers the product to Sun Yun on July 31, 2025. Question: what journal entry should Margot Company make in regard to this contract in 2025? Well, no entry is required on March 1, 2025, because neither party is performed on the contract. On July 31, Margot delivers the product and therefore should recognize revenue on that date, as it has satisfied its performance obligation by delivering the product to Sun Yun. The journal entry to record the sale and related cost of goods sold is as follows. So this is pretty standard. I think you'll remember. We'll debit accounts receivable and credit sales revenue for $5,000. We'll debit cost of goods sold and credit inventory for $3,000. After receiving the cash payment, then Margot makes the following entry by debiting cash and zeroing out its accounts receivable with a credit of $5,000. A key feature of this revenue arrangement is that the contract between the two parties is not recorded and does not result in a journal entry until one or both of the parties perform under the contract. Until performance occurs, no net asset or net liability exists. All right, collectability. Credit risk is the risk that a customer will be unable to pay in accordance with the contract. So here, as long as the contract exists and probable that the customer will pay, whether the company will get paid is not a consideration in determining revenue recognition. And number 2 here, the amount recognized as revenue is not adjusted for customer credit risk, and the company then presents an allowance for bad debts. Okay. All right, that one is pretty easy. I think you would recognize that from your original financial accounting course. So here's an example. In November 2025, Specialty Chef sells an assortment of knives to numerous customers for $800,000. Specialty Chef believes that control of the knives has transferred to its customers. In addition, Specialty Chef concludes that collection from its customers is probable. Based on historical trends, approximately 2% of the receivables will not be collectible. How much revenue should Specialty Chef recognize in November? Specialty Chef should recognize $800,000 in revenue. It should report the revenue gross without consideration of the credit risk. It then presents an allowance for any impairment due to bad debts, recognized initially and subsequently in accordance with the respective bad debt guidance as we discussed in Chapter 6. An impairment related to bad debts is reported as an operating expense in the income statement. All right, step 2. A performance obligation is a promise to provide a distinct product or service to a customer. A product or service is distinct when a customer is able to, one, benefit from a good or service on its own, or two, together with other readily available resources. The objective is to determine whether the nature of the company's promise is to transfer individual goods and services to the customer or to transfer a combined item or items for which individual goods or services are inputs. Let's take a look at an example for separate performance obligation. Here, General Motors sells a car to Olympic auto dealers at a price that includes 6 months of telematics services such as navigation and remote diagnostics. These telematics services are regularly sold on a standalone basis by General Motors for a monthly fee. After the 6-month period, the customer can renew these services on a fee basis with General Motors. Has General Motors sold one or two products here? If we look at General Motors' objective, it appears that it is to sell two goods, the car and the telematic services. Both are distinct. They can be sold separately, and they are not interdependent. General Motors has two performance obligations in this situation. Now, if it's not a performance obligation, let's take a look at an example. Softtech licenses customer relationship software to Lopez Company. In addition to providing the software itself, Softtech promises to perform consulting services by extensively customizing the software to Lopez's information technology environment for a total consideration of $600,000. Has Softtech sold one or two products? Well, in this case, the objective of Softtech appears to be a transfer of a combined product and service for which individual goods and services are inputs. In other words, Softtech is providing significant service by integrating the goods and services, the license and consulting service, into one combined item for which Lopez has contracted. In addition, the software is significantly customized by Softtech in accordance with specifications negotiated by Lopez. As a result, the license and the consulting services are distinct but interdependent, and therefore should be accounted for as one performance obligation. All right, step 3, determining the transaction price. 1, the amount of consideration the company expects to receive from a customer. 2, in a contract, it's often easily determined because the customer agrees to pay a fixed amount. And 3, for other contracts, companies must consider 1, variable consideration, 2, time value of money, 3, non-cash consideration, and 4, consideration paid or payable to the customer. Variable consideration. A company estimates variable consideration using either of the following methods. 1, the price is dependent on future events. That might include discounts, rebates, credits, performance bonuses, or royalties. And number 2, the companies estimate the amount of revenue to be recognized based on expected value or the most likely amount. So if we look at this expected value here compared with most likely amount, that's going to be, the expected value is going to be a probability weighted amount in a range of possible consideration amounts. And that might be appropriate if a company has a large number or contracts with similar characteristics, or can be based on a limited number of discrete outcomes and probabilities. The most likely amount, the single most likely amount in a range of possible consideration outcomes. And that may be appropriate if the contract has only two possible outcomes. Okay, let's take a look at an example of variable consideration. Here, Peabody Construction Company enters into a contract with a customer to build a warehouse for $100,000 with a performance bonus of $50,000 that'll be paid based on the timing of the completion. The amount of the performance bonus decreases by 10% per week for every week beyond the agreed upon completion date. The contract requirements are similar to contracts that Peabody has performed previously, and management believes that such experience is predictive for this contract. Management estimates that there is a 60% probability the contract will be completed by the agreed upon completion date, a 30% probability that it will be completed 1 week late, and only a 10% probability that it will be completed 2 weeks late. How should Peabody account for this revenue arrangement? Well, the transaction price should include management's estimate of the amount of consideration to which Peabody will be entitled. Management has concluded that the probability weighted method is the most predictive approach for estimating the variable consideration in this example. So what we do is we have, if we go back and look at this, here's the $100,000 warehouse and the $50,000 bonus. So if it's on time, there is a 60% that we're going to get both of them. Okay? And so we'll take 60% of 150,000, and that will be 90,000. If it's 1 week late, that 50,000 bonus falls to 45,000, and we think that's going to be a 30% chance. So we'll take 145,000 times 30%, which is 43,500. And if it's 2 weeks late, there's a 10% chance. So we're going to take this 140,000 times 10%. That'll give us 14,000. We add it all up, and it comes out $147,500 based on the probability weighted estimate. Management should update its estimate at each reporting date. Using a most likely outcome approach may be more predictive if a performance bonus is binary, and that is whether Peabody either will or will not earn the performance bonus, such that Peabody earns either the $50,000 or nothing at the agreed upon date. In this scenario, if management believes Peabody will meet the deadline and estimates consideration using the most likely outcome, the total transaction price, therefore, would be the $150,000, because that had a 60% probability in a binary situation. Okay, one word of caution though, only allocate variable consideration if it is reasonably assured that it will be entitled to the amount. And then under number 2, companies only recognize variable consideration if 1, they have experience with similar contracts and are able to estimate the cumulative total amount of revenue, and 2, based on experience, they do not expect significant reversal of the revenue previously recognized. If these criteria are not met, revenue recognition is constrained. This looks like a good place for us to stop this video, and when we return, we will carry on.